Good morning, everybody. Thank you for joining me today. It's February 5th, and well, the year keeps moving forward here, and so does the market. Except for today, we're down some on concerns that the economy might be too strong, which shouldn't be a problem, except for the fact that the market's been anticipating several rate hikes starting in March. The federal funds rate futures for the 12-month. I was anticipating five cuts, and the Fed and particularly Fed Chair Powell has been pushing against that idea, and looks like the market's finally paying some attention here. We've been in the camp that's been saying that the economy is doing fine, it's resilient, that these interest rates are back to normal interest rates, kind of where they should be. Maybe that the Fed funds rate should be somewhat lower, but the economy certainly can handle these rates, as has been demonstrated for the past 2 years. That being the case, there's no rush for the Fed to lower interest rates. That's been our take, and looks like it's being confirmed by Fed officials, particularly Fed Chair Jerome Powell last week. Basically, the message last week from Powell was the economy is doing well, inflation's coming down, but we actually want to see inflation at 2% as opposed to heading in that direction. He wouldn't be saying that if the economy was looking weak. So the combination of the economy looking quite strong with inflation coming down towards the Fed's targets, what's the rush? Why mess with success? And anyways, they only promised the markets 3 rate cuts this year, but the markets want more. I mean, what's wrong with 3 rate cuts? It's perfectly acceptable. There's no particular reason why any particular level of the interest rate has got to be bad for the stock market, bad for the economy. If quite the opposite, the economy demonstrates it's not a problem at all. So that's where we are. Markets having a little bit of a correction. I think a lot of it had to do with the markets were anticipating, waiting for the magnificent sevens. I call them the mega cap 8. They were anticipating their earnings. Some came out much better than expected. There were a couple of clunkers in there, but all in all, the mega cap 8, as I like to call them, took the market up to a new record high. And now there's some selling on the news, some profit taking, nothing to be concerned about in my humble opinion. Well, meanwhile, for those of you who are wondering where Max and Bailey are, they're not here. They're sunning themselves in the living room, where we get a lot of sun when the day is nice, and it's a beautiful day here. And we're supposed to have weather in the 40s and 50s over the rest of the week. So we're looking forward to a good week. I can't promise you that that'll be the case for the stock market, though the economic calendar is extremely light. So I'm not sure that we're going to have much on the economic front that will disturb the stock market. Well, let's look at some charts here related to today's morning briefing, which is all about productivity. Productivity is making a fairly remarkable comeback. We've been expecting it, but it's maybe sometimes when you expect something and it happens, you're saying, "Whoa, that really is happening." So that's kind of my take on it right now. Let me share my screen with you. Okay, so let's go here. All right, so this is, by the way, some of you asked for us to reestablish the PDF version of the chart collection, so we did that. And so hope that makes your life easier. I know some of you like to just print it out and read the text and then look at the charts, take some notes. So hopefully that's what you were looking for, and that's what we revived. So with regards to productivity, productivity is a magic variable. It makes good things happen when it's going up and when it's relatively high. 0 productivity is bad. 1 is better. 2 is even better than that. 3, 4, 5, and so on. And that's what this figure 1 shows you. It shows you that the arithmetic of real GDP growth is really very simple. Real GDP growth on a year-over-year basis is equal to the growth rate of the labor force plus the growth rate of productivity. So if we look at this blue line here, we like to do these kind of squiggly charts here. And so the blue line here is with zero productivity. It shows you what the economy can grow at just based on the growth rate of the labor force. Back here, the baby boomers flooded into the marketplace. I think I'm in there somewhere. You can probably see me right there. In the late 70s, I entered the labor market. So there was a lot of us, and we were fairly well educated, but we had no experience. And so the productivity of this new labor wasn't all that great, but it was relatively cheap. And as a result of that, we didn't really have much productivity growth in the 1970s. As you can see, we were actually at zero back here because real GDP is equal to the blue line plus productivity. So let's add productivity. This is adding 1%, 2%, 3%, 4%. It shows you what the potential growth rate of the economy is, given what the labor force is doing and given what productivity could be doing. And so you can see that real GDP here is 2.1% on a year-over-year basis. You can see that the labor force is pretty slim growth at 0.6%. So that implies, by the simple arithmetic, the productivity is growing 1.5%, which isn't bad, but it's not great. I mean, it's better than zero. It's not as good as 2%, and certainly not good as higher numbers, which we think are actually possible in the next few years. And that's the point of some of these other charts that we'll look at right now. So let's move on here. And this shows a chart that I've shown you before. The blue line is really what I want you to focus on. The red line is just another way of calculating the same thing. It just smooths it out a little bit. But the blue line shows the 20-quarter annualized percent change in productivity. So at any point in time, if you're down like here at close to zero, this said that you weren't zero for like one quarter, you were zero on average for 20 quarters. And so when we're up here at 3.5%, we were at 3.5% on average for 5 years. So it summarizes a lot of information. And the reason for doing it is because the quarterly and the annual year-over-year growth rates are too volatile. You don't get to see the cycle in them. And this way you can really see the kind of underlying cycle. So there was a boom in productivity growth back here in the 50s. There's another one in the 60s. Then we had productivity collapse down to zero. Again, the baby boomers came into the labor force. There's a lot of things that happened. We had a lot of competition from Japan. We didn't know how to produce cars. All sorts of things happened here that brought productivity down to zero. It just wasn't just the entrance of a lot of baby boomers. Then we had a little mini Ronald Reagan boom in the growth rate of productivity. That didn't sustain for very long. Again, I think it was competition from Japan that was a problem. And then productivity had a big surge in the late 1990s. Some of that was actual productivity. Some of it was we just made a lot of Dell boxes that got sold. And so the output of computers and IT equipment soared back then. There was also the year 2000 issue that led to a lot of spending on technology. And technology is not as labor intensive. So we produce a lot of computer boxes without a lot of labor. You get a big surge in productivity. How useful were those boxes, those computers, in increasing productivity for the overall economy? Not so much. As we can see here that after that surge in everybody getting a PC, we saw this productivity growth rate drop rather substantially. I think if you think back to what happened in that period back then, a lot of companies that had many secretaries working on Selectric typewriters could replace them with their Dell computers and Word and tell everybody type your own, do your own work on the computer. Then the other technology that was created back then was Excel spreadsheets. So if you had a lot of bookkeepers, maybe you could replace a lot of them with Excel spreadsheets. But other than that, I don't know that the technologies back then lent themselves to a whole host of increasing productivity in a whole host of different businesses. Whereas in the current environment, this ongoing technology revolution has evolved in such a way that it really is applies to everybody. Everybody can use the cloud, for example. Everybody can use all these various uh, Microsoft platforms now without having to have a huge IT department, because on the cloud, things can be updated automatically, and also things can be fixed remotely. So I think that the latest productivity growth cycle, boom, if you will, started back at the end of 2015, when the growth rate was only 0.5% for the previous 20 quarters. And we've actually been in a rebounding productivity cycle since 2015. We got up to about 1.5% before the pandemic, which is good. I mean, again, it's all gravy. It all goes straight into real GDP. Also, to the extent that productivity increases real GDP, it also helps to moderate inflation, allows wages to grow faster than prices. So there's a lot of magic about productivity. Ignore this whole thing. This is the pandemic, went up a lot, went down a lot. I think we're past the pandemic now. We're kind of back to trend, and the trend shows that productivity growth is almost 2% over the past 5 years, which again is getting better and better. And we think it's going to go to 3 to 4% in line with these previous productivity growth booms. This time around, the technology, again, lends itself to being much more useful to increasing productivity in many, many more businesses. Let's look some more at these productivity charts. This chart shows you the quarter-to-quarter percent change at an annual rate and the year-over-year percent change. So, as I said, the quarter-over-quarter, year-over-year are relatively volatile. You don't really get to see the cycle as well as you do when you do the 20-quarter annualized percent change. But what's interesting here is the past 3 quarters have been gangbusters. We've had very strong productivity growth on a quarter-to-quarter basis at an annual rate, and it's brought the year-over-year growth rate to 2.7%. So that's really quite impressive. This fourth quarter was 3.2%. Look at this chart, which looks at the quarter-over-quarter productivity numbers all the way back to the start of the data. And this is a line that moves up and down with the averages for the entire period. So it doesn't move very much, obviously. And what is clear here is that the average productivity growth going back to the 50s was late 40s was 2.1%. And as you can see, we've had 3 quarters where we're growing above that. It can be volatile, so I'm not promising you that it's up, and away from here, but that's kind of what I'm thinking in this roaring 2020 scenario that we've discussed previously on a regular basis. By the way, productivity is calculated as output per labor hour. And output is not measured using real GDP. It's measured using non-farm business output. So take a look at the morning briefing if you're interested in that statistical minutia. But non-farm business output accounts for about almost 80% of real GDP. Obviously, this takes out the government because the government's not all that productive. This is really focusing on non-farm business output, as you can see. But by the way, notice that it is worthwhile looking at the data because real GDP was up 3.1%, and excluding everything that's not included, we're up 3.3%. So the economy is doing well, measured either way. This is labor hours worked. This is so real GDP divided by labor hours worked. And what's interesting is you can see that while real GDP has been doing pretty well the past 3 quarters, aggregate hours worked has actually flattened out. And that's important to realize that, because when the employment numbers came out on Friday, everybody focused on the big increase in payroll employment during the month of January, over 300,000. So that kind of got everybody, whoa, that's about twice what everybody was expecting. I think there is something been funky about January's of late, where they've been better than generally expected. But the important thing to recognize is that for the point of view of the economy, labor input, the number of people working is one variable. The other variable is how much are they working? What's the average work week? So aggregate hours worked. Let's have a look at that. This is labor. This is basically it. It's aggregate hours worked. But this is just a closer picture of the same thing. So this is labor hours worked that's used to calculate productivity. And this is aggregate weekly hours worked. So we have that series on a monthly basis. This is quarterly. And on a monthly basis, we have aggregate weekly hours worked. It's in billions of dollars, billions of hours. And you can see that it's a big number. 4.6 billion was the weekly average for the month of January. And what you can see when you look at this red line, which is available monthly, is that it's kind of been stalling out, as you can see. So that's been good for productivity because real GDP has been growing faster than labor input, and that's a plus for productivity. It also means that we should look at Friday's number a little bit more closely and realize that while payroll employment was up 0.2% month over month, when you do the percentages, it doesn't look quite as amazing as 330,000 or so. But payroll employment was up 0.2%. Look at this. This is the average weekly hours. It dropped 0.6%. So aggregate hours actually dropped during January. And aggregate hours slowed down during the previous 3 quarters as real GDP growth picked up. And so that's why we've had this great surge in productivity in the past 3 quarters, which I'm extrapolating as a continuation of the productivity boom that started in late 2015. This average weekly hours honestly doesn't really make a heck of a lot of sense. It was across the board. I don't think the weather was that bad. It's seasonally adjusted anyways. It's adjusted for the fact that winter happens in January. So I wouldn't be at all surprised if this thing kind of reverses itself. So in February, my hunch is it's going to be a surprisingly weak payroll number and a surprisingly strong increase in average hourly earnings because, well, I think that's just maybe just the way the statistical analysis of the data plays out. But like the economy's doing fine, labor market's doing fine, no doubt about that. When employment comes out on Fridays at the beginning of the month, we always calculate our earned income proxy. That is non-farm payrolls. So that's what everybody got excited about, times the average weekly hours, times which people didn't pay much attention to, but they should have, and then times average hourly earnings. So non-farm payrolls were up 0.2. Average weekly hours was down 0.6. And then average hourly earnings was up 0.6. So on balance, this contributor to personal income was up, but barely. It was up 0.2%. Let's say that inflation, including energy, was 0. So it was kind of a modest increase in our earned income proxy, which, as you can see, is a very good proxy for private wages and salaries and personal income. By the way, when the numbers come out, we also look at this relationship. It shows manufacturing production versus aggregate hours worked in manufacturing. And you can see aggregate hours worked in manufacturing is still down. So we're still in some sort of growth recession or shallow recession in the goods sector, yet the overall economy is doing fine. And that's, as you know, the story we've been telling with regards to rolling recessions. So here we're looking at the economic surprise index. Tends to be pretty volatile, but we like to look at it. It's certainly been a great indicator for the bond market. When this economic surprises are to the upside, the bond yield tends to go up. When it's to the downside, the bond yields tends to go down with it. So clearly, the bond market pays attention to economic surprises. It's moved by them, and we're seeing some pickup here in this index. Back to that 20% change in productivity. One of the questions I get on a regular basis is, how do we know this productivity data is any good? It's got to be pretty hard to measure the variables that are required to make this calculation. And then you can get into all sorts of things like, okay, people are working at home now, maybe hybrid work, sometime at home, sometimes not. Does that increase their productivity or not? People aren't commuting as much anymore. They're working more hours. Does that count as productivity, or does it count as more hours? So there's a lot of issues along the way here. But I sort of joked in the morning briefing that when it comes to data, any data that supports my story is really good data. Any data that doesn't support my story is flawed. There's something wrong with it, and it's likely to be revised. And if it isn't, then there's something wrong with it. And if I continue to be wrong, then I'll change my views. But I try to stick with them, not through thick and thin, but as long as they make sense. And so there are ways to kind of cross-check, double-check whether the productivity numbers make any sense. For example, productivity is the driver of real wages. Wages divided by prices is basically determined by productivity. If you don't have productivity and wages go up, that goes straight into prices. If you get some productivity, then some of that wage is justified by the productivity. And as you can see here, there is a strong correlation between the kind of the mega cycles in non-farm business productivity and in the hourly compensation measure of wages, the real average hourly measure. And you can see this is turning around along with productivity. So check, that looks good. Here's another check. We've got monthly data on average hourly earnings adjusted for inflation. And this has been actually going up by 1.4% per year on average, and it's stalled out over here. Now it looks like when productivity went up and down and all over the place. Now you can see that the real wage for production and non-supervisory workers is back increasing, as is the total real wage. So that, again, real wage should go up when productivity is justifying it. Another relationship that is widely ignored by economists for some really bizarre reason. Economists are big believers in the Phillips curve. They've admitted that it's not working as well as it did in the past. They're saying that it's flattened out. They've come up with all sorts of excuses for the Phillips curve not working. It's that inverse relationship between unemployment and inflation, and it's kind of ingrained in the way policymakers think about the economy. They think there's a trade-off between unemployment and inflation. And so the only way to bring inflation down is to push unemployment up by having a recession. And that isn't necessarily the case. It's been the case. It's often been the case because it's clearly the fact that if we want to definitely bring inflation down, a recession will definitely do that. But it's a shame because if we can have economic growth based on productivity, productivity is disinflationary. And you can actually have an inverse relationship between the unemployment rate and productivity. Kind of makes sense of when the labor market is really tight and there's a real shortage of labor, that companies would say, well, we could pay higher wages and raise prices and kind of spin our wheels. Well, what's that going to get us but a wage price spiral? Nobody comes out ahead. If you want to come out ahead, you need productivity. So if there's a labor shortage, why not work on increasing the productivity of labor? And that, by the way, also is good for consumer spending, because if labor force is not growing, then the number of consumers and households isn't growing. So where's the growth going to come from for the consumer? And the answer is the purchasing power of the individual consumer, the individual household. And so productivity is what does that. So there is, as you can see in this chart, not an amazing, but a fairly amazing, fairly good relationship, inverse relationship between the unemployment rate and productivity. And the fact of the matter is, while a lot of people thought that inflation was going to be persistent, it's turned out to be transitory. And what's turned out to be persistent is the unemployment rate stuck below 4%, which is a good thing. And I think that's one of the reasons that we're seeing some incentive here to increase productivity. This is the last chart. So this chart shows another important relationship that kind of confirms productivity. If productivity really is improving, it should be visible. It should be having an impact on reducing the price inflation rate. And you can see that if you take unit labor costs, which is hourly compensation, offset by productivity, divided by productivity, you get unit labor cost inflation, which is the red line. And you can see that it's really a pretty good indicator of the underlying inflation rate for the CPI and the PCED in this case. This is the headline PCED. And you can see that the unit labor cost is down to 2.3%. It's got the right handle on it. The Fed wants 2%. So we're definitely in the right ballpark here for getting inflation down. With that, let me take the charts down. And looks like we made it through my presentation. Now, let's see if we can have a little conversation here. So, Joel, was the stronger job number somewhat attributed to the UAW strike? Thanks. Maybe partly, but a lot of it was in services. And so the services economy is still cranking out a lot of jobs. So I'd say it was a strong number. And I think there could have been some fluky stuff going on with January again, but well, let's see what the February numbers are. And I think they're going to be more moderate on employment growth. And I think we'll see a reversal in the work week. William, what role is AI playing in the increase in productivity? And what are the other important factors? I'd say at this point, AI isn't playing much of a role. It's been around for a while. I mean, isn't Siri and Alexis aren't they Alexa, I should say, aren't they sort of artificial intelligence? The thing that kind of I keep wondering about is if artificial intelligence is so amazing, why aren't these personal assistants that Apple and Google gave us, why can't we just have a conversation with them already? They've been around for a long time. So Jackie and I are assessing the AI phenomenon. I don't need it to make the roaring 2020s work. I can certainly point to it as technology that could have a tremendous impact on productivity. I think it's automation, it's robotics. I think it's just simply figuring out how to produce more with the workforce you have. Sometimes it's just a management problem. Let's see. So Ian, your take on the January new hires. I read one report stating January is always high due to seasonal factor. Another report stating temps were high. Your take? Yeah, all of the above. And we did discuss it briefly. So I think it was kind of fluky. What data would lead you need to see that I would need to see to raise your 2024 S&P target? It's funny. I happened suddenly getting questions. I was on Bloomberg this morning, and they asked me the same kind of question. It's like, all of a sudden, my target of 5,400 for the end of the year is viewed as being conservative, which is kind of strange because it's based on earnings per share of $250 this year, which is a big number, $270 next year, and then $300 per share in 2025. And so to get to 5,400 by the end of the year, I'm using next year's estimate as what the market will be anticipating. And so 5,400, 270 times a multiple of 20, not 15, gets you 5,400. And I thought that was pretty far out there. And now it looks a lot less far-fetched. But no, I'm going to leave it at 5,400 for now and indicate that I remain bullish for the next couple of years by saying 6,000 by the end of next year. But I think it's kind of interesting that 5,400 doesn't look like such an outlier anymore. What data would lead you? No, that was asked. Thank you. You answered my long-winded question from last week. Thank you, Brian. Carl, what are good resources for learning how to value and or price stocks? Thanks. Well, I've written a few books. Yeah, you can look on the website. They're available as a PDF to subscribers to our accounts. Wrote a couple on the value, the PE times E equation we use with forward earnings, and then our research on a weekly basis focuses on our way of looking at it. So you can look at our research, which I presume you have. Let's see. In case of no landing, what will be the implication to risk assets, in your opinion? It has been a no landing so far. I mean, we were supposed to have a recession in 2022, then 2023, and here we are in 2024. And the Atlanta Fed's looking at real GDP growing 3 to 4% in the first quarter. It's still early on. A lot can change. But yeah, I think if the economy continues to not to land, that will persuade the Fed that they're right to push back against the market's perceptions that there's going to be several rate cuts. I think in March, when they come up with the summary of economic projections, I will not be surprised if they show 3 rate cuts again, kind of pushing back against the markets. If they really want to push against the market, they'll show 2 rate cuts, but I don't think they're going to go there. I think they're just going to do the 3 rate cuts and stress that they didn't do it in March. They might do it ahead depending on the data, but they're certainly not going to do more than that if the economy continues to look pretty good. So that means the bond yield kind of hangs around 4%. That means the stock market comes to the conclusion, well, if the reason we're not getting rate cuts is because the economy is doing pretty well, then earnings are doing pretty good. And the bull market moves on, led by earnings rather than valuation, which is a healthy development. I'll take, I think, one more. Ed, you continue to hear continued job reduction, but displaced workers are being picked up. So this is a structural, not economic. Yeah. There are kind of lots of news about companies here and there letting go workers, but there's still a lot of job openings. A lot of companies need workers. So on balance, we have a very we have a great labor market. There's a lot of turnover. People quit. People lose jobs. People find jobs. There's a tremendous amount of turnover. If you think about 200,000 initial unemployment claims and multiplied by 52, that's the kind of annual turnover we get in the labor market when things are going reasonably well. So I hope everything goes reasonably well for all of you in the week ahead. And I look forward to our next conversation. Thank you very much.